Welcome to this Killik Explains finance video. This week, why shareholders should be wary of something called scrips. So on we go. Quick overview. Scrips allow firms to offer shares in lieu of a dividend. So what might happen is you are used to receiving an annual dividend from a firm. It's that kind of firm. You're relying on that yield. And what the directors do is they say, well, this year we're going to offer you some of your dividend in the form of free shares in the company. So you'll get part of the dividend in cash, let's say, and part of it in free shares. The question is that a good deal for the company? Probably, otherwise they wouldn't have thought of doing it. And is it a good deal for you? That's a bit less clear cut. So we're going to take a look at the reasons why companies do this, what they are in principle, just the basics here, more detail available elsewhere, and then whether or not it makes sense for you. Now then, over the last 3 years, these have been pretty big. So 55 billion, according to Redburn, there's a big number, is the value of European payout reductions accounted for by scrips. In other words, that is the value of dividends replaced by these free shares from companies, let's say. 1 in 8 is the proportion of firms using scrips in Europe, according to them. And if you're looking at just the UK market, 25 billion is the value of UK scrip dividends. So whatever these things are, there are quite a few of them around. Now, how they work. Exact mechanics do vary slightly from jurisdiction to jurisdiction, company to company. So here are the bare basics. The principle is reasonably straightforward. So the basic deal is this. A firm wants to make a distribution to its shareholders. Shareholders are used to receiving some form of regular distribution. So the standard method would be a cash dividend payment. But for various reasons, I'll come back to in a moment, here the decision is to do some sort of scrip dividend instead, replace part of the cash dividend with something that's a dividend represented by free shares, scrip shares if you like, and this will be equivalent broadly to what are called bonus and capitalisation issues. In other words, there are several different terms that more or less in the UK market mean the same thing. Now as an example, very simple example, cut out a few real life facts if you like, just to keep it straightforward to illustrate. A shareholder has 100 shares trading at £5 each, that's £500 worth, no rocket science there. The company previously offered a cash dividend. This time around it's saying, well, the deal on the table is a cash dividend of 15 pence per share. There it is. So there's your cash dividend, and a scrip dividend of 2%. Now this can be stated a number of different ways, but if they give you something like that, 0.02 per share held, that gives you the ratio of free shares to existing shareholdings. And there's a little formula normally applied to work that out. So a shareholder who accepts, and there is usually a choice about this, will receive a £15 dividend, and in this case 2.02 times 100, that's the shareholding at the top, extra shares in the firm. Now you might say, what's not to like? Well, let's take a look at this then. So why is the company doing this all of a sudden? Well, the motives vary, but it's partly to maintain the overall dividend level. So the company doesn't really want to declare a dividend cut as such. It wants to at least give the impression of maintaining dividends, perhaps on a promise further down the line of restoring the full cash dividend, let's say, and the reported yield. Number 2, it wants to save cash. So there's no doubt about it, by reducing the cash dividend this year, giving away a few free shares, that will help the company out in the short term. Maybe it is short of cash, maybe it's got an investment proposition, but for one reason or another, this is a cash saving exercise usually, and it acts as a check on shareholder loyalty, you might say, because if the company gets lots of acceptances, perhaps that indicates that shareholders are prepared to wait for a while until the full cash dividend is restored. And normally as a shareholder, you would probably want the full restoration of a temporary cut in the cash dividend at some point. Now, why do shareholders accept? Some people love these things. They're saying, well, I get more shares in the company. That means more voting rights. That means I've got a bigger holding and I haven't had to pay for it. Well, okay, let's take that back in a moment, take a look at it. But specific reasons, no stamp duty. So normally when you buy a share, you will pay 0.5% to HMRC as stamp duty. On these things, you normally don't. Secondly, there's no dealing commission normally. This is a transaction directly between the company and its shareholders. And thirdly, it does increase your shareholding. You're getting free shares. You have more shares at the end of it than you had before, but you're not being asked to pay for them. So what's not to like about that, you might well say. But, and here come the buts. Number 1, shares are not ultimately the same as cash. Cash is something you can bank and spend or actively decide to reinvest. Shares are not. So you're getting a paper reward in place of a cash one. So don't be fooled. The two are ultimately different. even if they're wrapped up into the same bundle. Number 2, earnings per share will be diluted when this is done, and I'll come back to that in just a moment, but in essence, you've got the same earnings spread over more shares now. And thirdly, it may lose some management discipline. In other words, a firm that does this once may be tempted to do it again, and the point is, cash dividends are harder to generate than paper ones based on scrip issues, if you want to see it that way. So, for companies that have cut back temporarily, try to almost bribe shareholders with scrip shares in the short term, I would personally want to see some sort of commitment to return to the full cash dividend in the not too distant future. Now, I made a point about dilution earlier on, so what was all that about? Well, let's go back to the example. There's your 100 shares at £5 each, so £500 worth if you like. The company would normally offer a cash dividend. The deal, remember, was 15 pence per share. There it is again, and 2 based on the ratio of free scrip shares. Now, at the bottom it just explains how in practice you would see the company calculate the number of shares it actually offers each shareholder. So I've simplified slightly, I accept that. The impact is what? Well, since the scrip issue, point 2 there, raises no new capital, the post-scrip share price will adjust downwards slightly in the absence of any other factors. In other words, from a textbook. Now, the real world isn't working textbooks. Why am I saying that? Well, because basically if the company is raising no new cash, if your portfolio was worth £500 before these free shares are issued, it's still worth £500 afterwards. It's just that there are now 502 shares, not 500 shares. So in my simple example, all other things being equal, which they rarely are in the real world, the average share price would correct around £4.90, let's say. Now, in the real world, of course, the company's share price in the open market might be doing anything. So if the company's on a bit of a roll, the potential dilution this could create might be masked by that. But nonetheless, you don't get something for nothing, and bear that in mind. And also you might be thinking, well, I've got greater shareholder rights if I take these shares. Well, if everyone else does, no, you haven't really. Okay, so that's also to be borne in mind. Email me on what is quite a large topic, editor@killik.com. To find out more about the specifics of these scrip dividends, editor@killik.com. And if you'd like to watch other videos and explore some of the things around the edges of this video in a bit more detail, killik.com/learn, and the tab you want is called Shares.